and we are offering these courses to students from around the globe. So it's not about just a particular country. It's an issue everywhere that when students come out of the exam hall, they say that we found MCQs tricky. Now, there is a very strong reason behind it that why people find MCQs tricky. Basically, the practice material, which every student relies on, that is the first and the foremost thing, past papers, right? And as far as the ACCA publishing policy is concerned, when you look at the past papers on ACCA website, they provide past papers, and their usual tendency is that past papers are usually provided specifically focusing section C, the long questions. The ratio of providing MCQs and MTQs which come in the exam, that is very less. So basically, when preparing for financial management or any F series exam, there is a lack among students of question bank that what exactly is the type of MCQs that come in the exam. Now, this is a problem which students also face, that they don't have any past papers for MCQs. And this is a problem which tutors also face, that we don't have any past papers for MCQs, MTQs apart from one or two. So we have to rely on KIT and usually the MCQ student report, because I haven't given the exam. I gave the exam long back. So basically students complain that the MCQs in the kits and MCQs that came in the exam are very different. So I basically started this session one night before the exam session since last attempt, where I basically analyzed different research reports and basically different articles and basically different stuff, and try to gather some MCQs as per my trend analysis, which I feel are going to show up as a repetitive form and are likely to come in the exam. So basically, I conducted a session last time as well, and students really were very happy with this session, and they said that our MCQ practice was improved and we were able to perform well in the MCQs. So similarly, I thought to make it a routine practice, and this is the second edition of this session that I am conducting one night before exam. In today's session, I will be solving few MCQs with you, which I feel are really important for tomorrow's exam. I have gathered this MCQs for different articles and different reports, and I will solve with them, solve with you, and I will explain it to you. And hopefully, if your luck counts, you might get topics, similar topics, MCQs in the exam, and you will be able to perform well in MCQs. And even because of this session, if your 2 MCQs or 3 MCQs go good, this increases your chances of passing. Okay. Now, as far as my introduction is concerned, people who know me, my name is Ahmed Shafi, and I've been teaching ACCA papers F2, F5, F8, F9, P4, which have now become MA, PM, AA, Audit Assurance, FM, Financial Management, and AFM. And I'm basically teaching since the last 12 years these subjects. And the photo in front of you, which is our display picture, we hold this picture very proudly because in 2019-20, we recorded the highest pass rates, we recorded the highest number of students taught and highest number of positions. So this is the list of my positions, the students I taught, and financial management and advanced financial management, the ratio of positions is almost in any attempt, plus the pass rates and stuff. So I really feel proud on this and want to impart my knowledge in the best possible manner. And due to this, every session, our scope in different countries increases. Okay, so let's just start now. Before formally starting the session, obviously I have to make this thing, whatever MCQs I will solve with you, I have to send a file to you as well. So I am just sharing a WhatsApp group link with you, with all of you in the chat. And after the session, it is advisable, or during the session, you just have to click. You need to join this group so that the file I share in that, even if someone is able to go out of the session due to any issue during the class, he will be able to read those MCQs. And if you need it before the exam in the morning, you might be able to grasp it. Okay. So just sharing that WhatsApp group link, and then we will start. Raza, most probably 1.5 hour. I have to solve some MCQs with you. No, Adil, this is only for MCQs, not for Part C questions. So I've just sent the WhatsApp group link on this chat, and you can join this after the class. So let's start now. So Johnny, where did you find the section C approach? The group will also help you that in case you need to ask any questions, you can ask after the class. Now, without wasting time, we should start the preparation of MCQs. Now, disclaimer in the start that don't consider that these MCQs mean that they are going to show up in the exam or stuff like that. It's just my analysis that these are the MCQs preferred by the examiner in the previous classes or previous exams. So most probably, as per my analysis, that I personally think that they will be helpful for you, and you should do it before going in the exam. I will share the file as well with you. Okay. Now let's start. And I would advise you that please focus on the MCQs now. Okay. Okay. So basically, question number 1, which I consider as an important MCQ for the exam. Increasing which two of the following would be associated with the objective of shareholder wealth maximization? Okay, increasing which two of the following? I'm not asking questions from any one of you, so please spare the chat box for a moment. I will solve it, and you need to just note down the answers, and after that, the file is yours. Okay, increasing which two of the following will be associated with the financial objective of shareholder wealth maximization? Share price, dividend payment, reported profit, earnings per share, and weighted average cost of capital. The question is asking increasing which two of the following. You need to select two options. Increasing which two would be associated with the financial objective of shareholder wealth maximization? Which two should be increased and it results in shareholder wealth maximization? Okay. Now, consider yourself as the shareholder. Okay. If the company's weighted average cost of capital, option E, increases, will your wealth increase? No, it's company. Company's cost of capital increases doesn't mean you will get any benefit. Increasing earning per share, people say earning per share increase, and option C, reported profit increase. Both are irrelevant. In fact, they're saying Profit and earning per share is the same thing. Profit means total and earning per share means profit per share. If they both increase, does the shareholder's wealth increases? No. Why? It's company's profits increasing, company's earning per share increasing. What is the shareholder getting? Remember, if I am a shareholder of the company, if you are a shareholder of the company, our wealth will increase only by two things. One, dividend. If company gives you dividend, then obviously your wealth is going to increase. Okay, you earn something. And secondly, share price increases. That yesterday a share price was $10 and now the share price is $15. Did your wealth increase? Yes. So if you increase these two, share price and dividends, then only your wealth will increase. So the correct answer for question number 1 is going to be A and B. Okay. Next question. Following information is available for a listed company. Dividend recently paid. Now, dividend recently paid is 0.1 per share. Dividend cover is 4 times. The PE ratio is 5 times, and estimated future growth in dividend is 80%. Using dividend growth model, what is the cost of equity of this company? There's a request from a student that all of you please close your cameras, because I think the camera video should only be on from my side and yours shouldn't be open. And if you have any questions with respect to these MCQs, I cannot answer you in between the session. You need to contact me later. Okay. Secondly, the following information is available for a listed company. Dividend recently placed is 0.1 per share. Dividend cover is 4 times. Price earning ratio is 5 times, and future growth in dividends is 8%. Using dividend growth model, what is the cost of equity of this company? Now, cost of equity is basically KE, right? Cost of equity is basically K. Using DVM, what is the KE? Now, if you all remember, obviously it's one night before the exam, you must know that KE, cost of equity through DVM, is D1, next year's dividend, over P0, share price plus G, right? Dividend per share, next year's dividend, over P0 plus growth rate. Now, what is the growth rate? Growth rate is 8%, 0.08. Okay. Now for D1, I need to take today's dividend, that's 0.08, sorry, 0.1, today's dividend, and add the growth rate, 8%. I will get next year's dividend. It's 0.108. Okay, we all know that next year's dividend is generated in this manner, that it's 0.108. Today's dividend, add growth, we get next year's dividend over share price and the growth rate, that is 8%. Now, how do you get the share price? How do you get the share price? Okay. Now, check this. Dividend cover is basically earning per share over dividend per share. Okay, dividend cover is basically earning per share over dividend per share. Okay. And PE ratio is basically market price per share over earning per share. Okay, dividend cover is basically earning per share over dividend per share. Okay, and market price per share over earning per share is basically PE ratio. Okay, sorry for that. Now, in this question, I was being asked to find cost of equity for the company, KE for the company, right? Under DVM, KE is D1 over P naught plus C. Now, D1 is the next year's dividend. To get the next year's dividend, we take today's dividend and add growth, 8%, that's 0.108. G is 0.08, we just need market price per share. Now, market price per share is not given in the question, but look at that piece. Dividend cover, it's earning per share over dividend per share. And P ratio is market price per share over earning per share. Let's just multiply them. Dividend cover into PE ratio. Pay attention to that. Now, dividend cover into PE ratio. Dividend cover is 4 times. Okay. And multiply by PE ratio was 5 times. So this makes it 20 times. I broke them 20 times is multiply EPS over DPS into market price per share EPS. Just cancel them. This means market price per share over dividend per share is 20 times, right? And you have the dividend per share 0.1. You have the dividend per share 0.1. So just pay attention to this. Dividend per share is 0.1 and you need market price per share. So I'm just going to multiply this 0.1 by 20. This will make it 2. And 0.108 over 2 plus 0.08%, this gives the answer as 13.4%. Okay, you can copy the solution and any questions you can ask. So it's just the thing that when you talk about cost of equity and a dividend valuation model, it's simply D1 over P naught plus G. So D1 was the next year's dividend. It's 0.108. Today's dividend at growth over share price plus growth rate. Share price was not given, so I computed myself, made a formula, dividend cover and P ratio was given. I know what is dividend cover, what is P ratio. I multiplied them to get 20. EPS was cancelled. Market price per share over DPS was 0.1 and you got share price as $2. So Sabah, market price per share over 0.1, the dividend per share was 20. So you just multiply 0.1 by 20 to get the market price per share. Now let's move to question number 3. Which of the following is a description of gap exposure? That's just straight from the Kaplan text. What is gap exposure? You might have studied this in interest rate risk management. Okay, gap exposure is how much interest rate risk companies facing from borrowings and deposits. And the name of borrowing was interest sensitive liabilities and the name of deposits was interest sensitive assets, because deposits are assets and liabilities are borrowings. So the difference between deposits and borrowings is the exposure companies facing in interest rates. The correct answer of this is going to be B. Let's move to question number 4. Again, regardless of the questions are difficult or easy or normal, you must practice them before going to the exam hall, because as per the recent reports, I personally feel these have the chances of getting repeated. A company is appraising a 3-year project which requires an initial outlay on 1st January 2004 of 30,000. The project is expected to give the following cash inflows on 31st December each year. Okay, so 10,000, 20,000, 25,000, all of the above cash flows are before taking account of specific inflation of 5% per year. They are before inflation. Okay, and real cost of capital is 4%, nominal cost of capital 14%. Okay, using nominal approach, what is the NPV? So it's simple that it's 0 and 3 cash flows. Okay, so the investment was 30,000, and in year 1 you were getting 10,000, which was before taking account of inflation. So 5% per year means 1.05. It's 10,500. And in year 2, the amount was 20,000 before taking account of inflation. So in year 2, the inflation is 5% per annum. So in year 2, it will increase by 2 times. 22050. And in year 3, it's 25,000. 5% per year means it will inflate 3 times. 28940. So these are the inflated cash flows. Okay. And you need NPV, so multiply with the discount factor. Since you have inflated, you need to take nominal 14% 1. In the tables, I see 0.877, 0.769, and 0.675. Multiply them to get the present values. $30,000. 9208. 16956. 19534. Okay, and if we net them all, the NPV is 15,700 approx positive. Okay, now moving towards the question number 5, and I need you to pay attention to theoretical MCQs as well as when you're going into the exam, or basically do these before going them. So which of the following are true? A conservative working capital investment policy implies a higher proportion of permanent current assets to fluctuating current assets, and long-term finance is cheaper than short-term finance. Okay, now which one is correct? 1 only, 2 only, 1 and 2 are correct, 1 and 2 are incorrect. Now this conservative working capital policy, basically you studied 3 policies in working capital if you have gone through the study text. Okay, 1 aggressive policy of working capital, then conservative policy and moderate policy. Okay, conservative, aggressive, and moderate policy. Okay, aggressive policy, short term, keep low levels of investment in working capital, and aggressive, sorry, short term, and low levels, conservative, high levels. Okay, and some in permanent and some in fluctuating, that was not conservative. That was basically moderate. Okay, the statement one is saying about moderate, that's incorrect. And second, long-term finance is cheaper than short-term finance, that's perfectly incorrect. Why? If someone is lending you for long-term, that's more risk for them. So more risk means he will charge more return. So long-term finance is more expensive than short-term. So correct answer is D. Conservative working capital investment policy, aggressive working capital investment policy, and moderate working capital investment policy. There were three policies. Conservative says that maintain long-term investments in current assets. Aggressive says short-term, low levels. And this is a moderate, that permanent and fluctuating should be with a ratio. So permanent and fluctuating is dealt by a moderate approach, not by a conservative approach. That's why one is incorrect. Now, this is an important question, and people usually ask me that how we should have dealt this question in the exam if it comes. So you are getting an opportunity to learn one more stuff here. Salmon Company is planning a 144 right issue. The value of right has been calculated as 0.4 per existing share. Okay, Salmon's market price is currently 7 per share. What is the theoretical extra price per share, TERP, and the right issue price per share? There are 6 options: 5, 5.4, 6.2, 6.67, and 7.4. You have to select what is the TERP and what is the right issue price per share. What is the TERP and what is the right issue price per share? Now, how is TERP calculated? Okay, TERP is calculated like it's 144 right issue. That means before right issue, a person must have 4 shares. And those shares are trading at $7 per share. So his worth is 28. Okay, he gets 1 share. At what rate, we don't know. That's what we have to find. What is the right issue price per share? We don't know. So we combine them, that after right issue, he has 5 shares. And the combined worth is the total. And then we divide both of them to get the TERP. Okay, this is how TERP is computed. Like, let's suppose I would have told you that Salmon is planning a 144 right issue and the share is being issued at $6. So you would have said, okay, there are 4 shares before right issue at 7.28. 1 share was issued at 6. So this makes it total, and we divide it to get TERP. Now, TERP is the theoretical extra price, the price after right issue. Now, what we do is, whatever is the right issue price per share after right issue TERP, we deduct from it at what price the new share was offered. So we get value of right per new share. Okay, and then whatever is this value of right per new share, whatever is this value of right per new share, we divide this value of right per new share with how many existing shares company had. How many existing shares? 4 shares. So we basically get value of right per existing share. Now, this is the whole story of TERP, which I've told you in summary, that theoretical extra price is basically 144 right issue. So before right issue, person must have 4 shares at let's suppose 7. The market price is 7, and he got 1 share at whatever price, I don't know, that's what I need to find right issue price per share. So you get the combined share and the combined price, and then you divide it to get TERP. TERP is the right issue price, market price per share after right issue. We deduct at what share, at what price we made right issue. We get value of right per new share, that's the gain. And then we divide it by 4 existing shares, whatever existing shares company had, we get value per existing share. Okay, now I am extremely short of data here. I just know that's 144 right issue. Value of right is 0.4 per existing share. Please note, value of right is 0.4 per existing share. That's given. Okay. And market price is currently 7 per share. So let's just start. I have to find what is the TERP and what is the right issue price per share. So I have 6 options. I need to work what is the TERP and what is the right issue price per share. Now kindly pay attention to what I'm saying. I have told you that value of right per new share divided by whatever existing shares. Value of right per new share is the gain the company got from new share. You divide it by existing shares, you get value of right per existing share. Okay, so value of right per existing share has already been given as 0.4 value of right per existing share. Okay, and there were 4 existing shares, right? Okay, so you can basically get the value of right per new share. Okay, so 0.4 multiply by 4 shares, you get 1.6 as the value of right per new share. This value of right per new share is 1.6. I don't know the TERP, I don't know the right issue price per share, so how to get the TERP? Now, simply do one thing, find the right issue price per share. Once you get the right issue price per share here, you get the TERP, and that's it. But I don't know what is the right issue price per share. I need to check each and every option. That's a strategy. Use the options to find out. Let's suppose option 1 is right issue price per share is 5. Let's suppose right issue price per share is 5. So I basically do this, that 4 shares were trading at 7.28 and 1 share was issued, let's suppose, at 5. So this makes it 5. So after right issue, 5 shares are at 33. I get 33 for 5 shares divided by 5, 6.6. Let's suppose I believe 6.6 is the TERP. Now, if I say 6.6 is the TERP and right issue price per share is 5, 6.6 is the TERP and right issue price per share is 5. Do I get 1.6? Yes, 6.6 is the TERP and right issue price is 5. So do I get the value of right per new share as the gain 1.6 and I divide it by 4 shares, I get 0.4. That means right issue price per share is $5. My answer is verified. And the TERP which I calculated is 6.6. Now, if I use any other option, you try, use 5.4. If you use 5.4, I was lucky I got it in the first instance. If you use 5.4, your TERP would arrive. And if you will deduct TERP from right issue price per share, you won't get 1.6. You won't get 0.4. If you use 6.2, you can check. You will get a TERP, but if you will deduct the TERP from right issue price, you won't get 1.6. So the answer usage, option usage resulted in an answer of 6.6 and 5. You can note this and any queries you can ask. Obviously, the question is made to make your life easy. If you will say that nothing is provided and solve the question, obviously it's not possible. Because for solving of any question, we need data. If you don't have data, you cannot solve simply. $33 is the combined worth of 5 shares. So you divide it to get the TERP 6.6. Yeah, 7 is the come right price, Hamza. Rishabh, 1.6 is the value of right per new share. You got a gain of 1.6 on new share because your TERP was 6.6. Okay. And your right issue price per share was 5. Okay. So right issue price per share was 5. And your price after right issue TERP was 6.6. So you got 1.6 gain on new share. And you spread it on all 4 shares, you get value of right per existing share. You need to answer questions here in chat box. I'm not seeing the WhatsApp group at the moment. I will see it after the class. Osman, value of right per new share is the gain you got on new shares. We divided by the existing shares we have, we get value of right per existing share. Though the question gave us value of right per existing share as 0.4. We divided it 4 existing shares into 0.4, we get value of right per new share. Yeah, Sharia, you don't have any other option. Airach, 0.4 is the value of right per existing share. It's not the value of right per new share. Yes, you can do, Mashal. Fahad, we used the options which were given 5. Okay, now question number 7, again a theoretical question. Which two of the following statements concerning the interest rate risk management method of smoothing are true? Which two of the following statements concerning the interest rate risk management method of smoothing are true? Now, if you have studied interest rate risk management, there is a method which we studied in interest rate risk management, or you studied in interest rate risk management, matching, smoothing, and FRS. Now, there is a method matching, which states that keep a combination of borrowing and deposit to minimize interest rate risk. Now, there was an other method which was called smoothing. Now, if you know smoothing, you will be able to answer this question. Now, what was smoothing? Smoothing was basically that you need to keep a combination of fixed and floating rate debt, so that if interest rates increase, the floating rate portion increases, but the fixed portion won't increase, and that is a saving. If you completely take the floating rate debt, and interest rates go up, you have to pay more interest. But if you have a combination of fixed and floating rate debt, interest rates increase, your floating rate portion would increase, but fixed won't increase. Okay. So, which two of the following statements concerning the interest rate risk management method of smoothing are true? Option A, the debt portfolio will consist of a mixture of fixed and floating rate. That's what exactly smoothing is. That debt portfolio consists of fixed and floating rate. So option A, but you need to select which two. Interest payments will still increase if the interest rate rises. Yes. Even if you do smoothing, fixed and floating rate, even if interest rates increases, you still have some floating portion. So if floating rates will increase, interest rates will increase, you still have to pay higher interest. So A and investments with a fixed cash flow will be financed with fixed rate debt. Smoothing doesn't talk about financing. Full benefit will be obtained from a fall in interest rates. If interest rates fall, you won't get benefit. Only there will be a loss because the floating rate portion would fall. Then net effect will be a payment. No, net effect can be payment as well as receipts. So option A and B are correct. It asks which two. We need to discuss two. Floating rate basically means variable rate. So in variable rate, it happens when interest rates go up, more interest. If interest rates falls, less interest. Okay, now the next question. Black company has an issue 5% irredeemable loan notes. The loan notes are irredeemable. Nominal value of 100 on which interest is shortly to be paid. Black company has a before tax cost of debt of 10% and tax rate is 30%. What is the current market value of one loan note? It's asking market value of one loan note. Now, people usually do that when they are asked about market value of loan note. They say, okay, market value of loan note is the present value of two outflows, interest and redemption discounted at KD. You're right. But please pay attention. That was for redeemable loan note. This one is irredeemable. So remember the topic of WACC. For irredeemable loan notes, your KD is I over P naught. Your KD is I over P naught. So I is the interest amount and P naught is the market price of loan note. So what is KD? KD is the cost of debt. That's 10%. Okay. You need P naught. So P naught has to be found. And I is the interest. 5% interest. 5% of what par value? 100. So it's 5. So you divide 5 by 0.1. P naught becomes 50. Okay. Yes, Fazan, you're right. P naught goes there and 10% comes down. Diwan and Adil, the formula of KD is I over P naught, okay, for irredeemable debt, okay. So you took before tax KD, so you will take before tax interest. If you're taking after tax KD, you have to take after tax interest, right? Tax is only charged on interest. Market price has no link with tax. Daniel, I don't know what calculation you are performing here. It's 5 over not 10, 5 over 10%. 10% means 0.1. So you do 5 over 0.1, you get 50. It's not a problem about tax. These people who are saying about tax, there is absolutely not a problem. They are saying that they use after tax. Doesn't make any difference. The formula for after tax is interest 1 minus T over market price. So you take KD 10%, make it after tax 30%. You take interest 5, make it after tax 30% over P naught. Okay, so this will create a figure here. 10%, 1 minus 0.37%, 5, 1 minus 0.3 will make it 3.5 over P naught. Do it this way. Take P naught above 3.5 over 7%, still 50. Because tax is not at one place, it's at both places. Market value is always quoted in X dividend or X interest form, right? So like when you are asked to calculate share price is always calculated on an X dividend basis. So market price is also always X interest, okay? Excluding interest, not including. Question number 9. A company that has a 14 million loan with a variable rate of interest has acquired a forward rate agreement with a financial institution that has offered a 4-11 2.85% at 2.35% spread. A company has a 14 million loan, variable rate of interest. It's a loan, right? Variable rate of interest. It has acquired an FRA with a financial institution that has offered a 4-11 2.85% at 2.35% spread. Now, I hope one night before the exam, you know what is the meaning of these terms. 4-11 means it starts in 4 months and lasts for 7 months. 4-11 means starts in 4 months and lasts for 7 months, right? Like it's 3-6 starts in 3 months, lasts for 3 months. The gap is always for how long you will be needing loans. So it's 7 months. And 2.85%-2.35% means there are two interest rates. Lower is the deposit rate and higher is the borrowing rate. Because that's the rule in the banks. The borrowing is always at a higher rate than deposit rate. Okay. What would be the amount received from the financial institution under FRA if actual rate of interest was 3.75%? Okay. Now understand this FRA. FRA involves rate fixation, right? You have a 14 million loan. You need it for 7 months. And financial institution is offering you FRA at 2.85-2.35. That means borrow at 2.85 and deposit at 2.35. What is the amount received from financial institution if actual rate of interest was 3.75%? Okay. Now, you know, if you enter into FRA, the rate gets fixed. If you enter into FRA, the rate gets fixed. 14 million loan. If you enter into FRA from financial institution, the rate gets fixed 2.85%. But loan redebit at 2.85%, this is for whole year. You need for 7 months, so you need to do it 7/12. Okay. So if you enter into FRA, the 14 million loan you need to take, the rate will be fixed 2.85%. And you need it for 7 months. $232,750. That would be the rate fixed by the financial institution if you enter into FRA, because you will borrow at 2.85. You are not depositing, you are borrowing 14 million for 7 months. What would be the amount received from the financial institution in the terms of FRA if actual rate is 3.75? Now, if actual rate is 3.75%, if actual rate is 3.75%, the interest you have to pay is 14 million, 3.75%, not for the whole year, for 7 months only. If FRA has entered, the rate has been fixed. But what would be the amount received from financial institution if actual rate is 3.75? If actual rate is 3.75, you will pay interest at 3.75%. 14 million, 3.75% for 7 months. $306,250, right? If actual interest rate is 3.75, you have to pay 3.75. But in FRA, you have committed with the institution that your net cost is fixed at 232,750. So actual rate is 3.75. You have to pay 306,250. But from the financial institution, you have committed that your net cost is 232,750. So you will receive the money from financial institution because they fixed the rate at 232,750, and now the cost is 306,250. So they have to pay the difference. That will be your gain, 73,500, and that's your answer. This amount financial institution has to pay because they locked the rate at 2.85 and the market rate is 3.75. So they have to pay you the difference, 73,500. Your net cost remains 232,750. Okay, so 73,500 is the answer. Mashal, it's your gain. How it's your gain? Because someone else will pay you back. The financial institution has to pay you because they contracted you that 232750 is the locked rate and your cost is 306250. So they will pay. That's your gain. Had you not entered into FRA, you will have to pay full 306250.
आप उससे बात कर ताकि 2 घंटों में एक टॉपिक जो है अच्छा खासा उससे पूरा किया जा सके.
Mashal, we don't pay to the financial institution. We just lock the rate to them. We pay to the bank. Bank will ask 306250. We will go to them and say that you locked at 222750. So this is the gain. Amir, obviously they have to pay. Okay, question number 10. Small and medium-sized SMEs often face a funding gap problem. Okay, now what is funding gap? It's a general English term. That funding gap means you're short of funds, right? So SMEs face a funding gap. If I'm facing funding gap, that means I have a shortage of funds. Indicate whether the following statement about SMEs are true or false by selecting the correct answer. SMEs will offer experience a funding gap due to them being seen as a higher risk investment than a large company. SMEs will often Reshawar, thank you very much for the comment. Yes, I know that hedging is a topic which usually students fail to understand. And that's why I specifically put a YouTube video on hedging topic. And you're saying that's your 5th attempt and you never understood that and you understood through my videos. So it's really a moment of satisfaction for the tutor because the tutor only needs motivation. Obviously, there are many students, so they are paying, they pay, we receive money from almost every student, but not everyone gives us the motivation. So again, thank you very much because that encourages us to do more. And that's why this is an open session for everyone because it's just motivation that allows us to do this. Okay, thank you. Okay, SMEs will often face a funding gap problem. Indicate whether the following statements about SMEs are true or false by selecting the correct answer. SMEs will often experience a funding gap due to them being seen as a higher risk investment than a large company. SMEs, small enterprises, always face a funding gap. Why? Because people see them as a higher company that they will open and tomorrow they will close. So as compared to a larger company, they will face a funding gap. Statement is true. Founding shareholders of SME will often have to sacrifice limited liability in order to obtain bank. Now, if you say that my company is a limited liability company, banks don't give finance. They say, okay, you are a limited liability company. That means if we give you finance, our liability will be limited. In case of default, liability is limited. Okay, not giving you finance. So founding shareholders have to sacrifice limited liability to obtain bank finance. They say, okay, full liability is ours, then they give finance. A lack of suitable, sufficient non-current assets increases the funding gap problem for SME. SME don't have too much assets which they can mortgage. So this also increases the funding gap. This is also true. So all these statements are true. Anik, larger companies have assets. They can mortgage them. Okay. So basically, if they can mortgage them, they can immediately raise finance. But SME, small entities don't have too much assets. So obviously, if they don't have too much assets, who will give them fund? No, no, Raza. Raza Jaffrey, maturity gap is basically an alternate name of gap exposure. It's an alternate name for gap exposure. It's not the funding gap. Okay, so I am now done with these 10 MCQs. So I will be ending this session now. Now I have research and my research is in progress, and I might be having 4 or 5 more MCQs shortly from my research papers. I will share them with you as well. So I will make a file and I will send the complete file of these 10 as well as the file of that 4, 5, 6, whatever I believe is likely to come up. So please join the WhatsApp group. I would be really appreciating if someone shares the link for others again, because I have to go through the whole chat to get the link again. So please share the link of the WhatsApp group. I will be sharing the file with complete answers. Yes, Mamoon, obviously with the answers. Thank you, Raza. So obviously I will be sharing them with the answers, and I would again strongly advise you that before going to the exam, just go through them. Maybe your luck counts and they get repeated. Okay. You're welcome, everyone, and please remember in prayers. Beshram, you can go to my YouTube channel and you can see there about this hedging. Okay, so now we will communicate on the WhatsApp group. Thank you.